Welcome back to the Bitcoin Layer. I'm Nick Bhatia. Today, we have the pleasure of welcoming back Michael Howell of CrossBorder Capital. Michael, it's wonderful to see you.
Great. Very good to be here, Nick. Lots going on, as you know.
Yes, of course. Well, everybody wants to know your outlook on global liquidity. So we will get to that second. But first, I want to ask you something. People are asking us all the time because we are trying to build a liquidity metric ourselves that is inspired by your global liquidity index. And people are always asking me, hey, what's the difference between your index and CrossBorder Capital's? But they also get confused about M2 versus asset-based liquidity metrics like yours. So my question to you, first question to you is, people that are using global M2 as a global liquidity metric are not using the same thing you are, because you're using an asset-based measure. M2 is a liability-based measure. But how similar are they? Is global M2 relevant, 100% correlated, mostly correlated to your index? And how would you explain that to people? Because for people out there, global M2 is publicly available. Your index is privately constructed. So can you answer that for us, please?
Of course, yeah. The reason that we look at our measure of liquidity is that it's a much more accurate way of actually understanding the flows of money through world financial markets. And M2 is, by definition, the deposit liabilities of retail or high street banks. Okay. Now, if we go back 50 years or so, when there was virtually no activity or very limited activity in financial markets, retail deposits in the high street banks were a pretty good measure of money or liquidity. Okay. Today, 50 years on, where you've got a huge financial system where most transactions are actually in financial markets rather than the real economy, M2 is a very bad measure of that financial activity. In fact, it misses the bulk of it by definition, because it doesn't count flows of money that are between financial institutions. So there may be at times correlation. I mean, I'm not going to deny that the two may at times move together, but for the most part, they don't. They're very, very different series. And as you said correctly, our measures are an asset measure for financial institutions. They're effectively a credit measure, whereas the other measures are the deposit liabilities of those institutions. And that's really a measure of their funding. Now, you can think about this in a whole number of different ways to show, what I'm saying is probably makes maybe more sense. It's that a lot of financial institutions now don't fund themselves through deposit liabilities from the retail public. They fund themselves through the money markets or through the repo markets. And the world has moved on, basically. M2 is an archaic measure. It may at times work, but it's not a consistent measure. And therefore, we basically say, look, money matters. There's no question about that. But credit really counts. And that's what we're measuring. And credit in the financial system is really what you want to understand, because that's what's driving financial asset prices.
Brilliant. So the world has moved on from measuring money from a deposit liability perspective because the world is financialized. Therefore, the flow of money happens through bank credit creation, and that is not measurable by deposit liabilities, which is what M2. And that's very important for people to understand. And it's not something that I believe is very easy to grasp, because I have already studied your work on asset-based liquidity. And I know that people might want to go check out our conversations together. We've had several at this channel where we've gone through that. And basically my attempt to be your student in understanding asset-based liquidity. So there is a hurdle there for people, but we will keep explaining that for people as we go. Join me for a free online event on Monday, March 17th at 11 a.m. Central. The event is titled Death, Taxes, and 21 Million. Protect your generational wealth before time runs out. Discover why Bitcoin is the ultimate scarce asset and why protecting your share of 21 million through tax strategies and careful inheritance planning is so important. We'll talk about why Bitcoin's 21 million brings certainty to an uncertain world. And with April 15th fast approaching, we'll go through those tax strategies and what IRA products you have access to with Unchained. Discover inheritance solutions like trust vaults and multi-sig. And also, if you have an advisor like a CFP or an attorney, make sure to invite them along so they can learn about tax strategies for Bitcoin with you. Go to unchained.com/TBL for all the information. Don't write your seed on paper. It's estimated that so much Bitcoin is lost forever. And the main culprit, the main reason is poor seed phrase security. This is why we use Stamp Seed, a DIY kit that enables you to hammer your seed phrases into titanium plates using professional stamping tools. These plates are heat resistant up to 3,000 degrees, fireproof, crush proof, and time proof. They're compact and easy to hide, and they can be used in your single sig or multi-sig setups. Make sure you go check them out today at stampseed.com and use code TBL for 15% off of your order. So Michael, let's move to global liquidity. Markets have been volatile since the administration change. Go for it. What is your index saying and what is your outlook here?
Well, I think there are two things that one's got to try and understand in terms of what's going on. The first thing to say is that our perspective of how markets operate is that there are two moving parts. One of those moving parts is clearly the flow of liquidity. And the second moving part is the deployment of that liquidity into risk assets or into different assets, be it safe assets or here risky assets. And two things have really gone on, if you like, over the last 3 to 4 months. One is that the pace of liquidity has slowed down. Liquidity creation has slowed down. In actual fact, we refer to that as an air pocket. There are some signs that the world may be climbing out of that right now. But the other moving part, which is the allocation of that liquidity to risk assets, or the asset allocation process, has changed. And what you're seeing is a very clear move now of investors out of risk assets. Now, I want to show that, and I'm going to show that in a chart, which I'm going to put up in a second when I get there. This chart. Now, you can see this chart, which is showing investors' risk exposure. And I'm going to explain how we put that together first. And this is measuring the deployment of liquidity into risk assets or into safe assets. Now, the orange line is measuring that asset allocation. 0 is a long-term neutral allocation. So at 0, investors are at their typical equilibrium or typical historic allocations. For example, that might be 60% equities, 40% bonds, for argument's sake. But that's a normal asset allocation. And as you move up or down on that scale, what it's showing is either more risk-seeking behavior. So if you move up and the calibrations, the 20, the 40, the 60, each one of those lines is one standard deviation. Now, if you move down below the 0 line, then investors are going more into safe assets. And we're basically defining risk assets as being equities, being cryptocurrencies, although they're a very small part of this, one would accept, but they're clearly influenced by risk-seeking behavior. Corporate debt, emerging markets are in there as well, emerging market bonds, for example, and safe assets are basically liquid assets and G10 government bonds. So that's how the statistic is calibrated. Now, we've overlaid a 9 to 10 year cycle on that data. I mean, that may be an accurate depiction. It may be spurious, but it gives the eye something to follow. And what you're seeing right now is that risk behavior is starting to move lower. Now, if we disaggregate in this following chart, the US from the world, you'll see what's happened to US investors' risk-seeking behavior. It's basically falling off a cliff. And that has principally occurred in 2025. This is daily data that we're looking at here. But you can see how that's come down very, very sharply. It's not unprecedented. There have been periods before. But the point being is that what's really driving markets now is an attempt to try and shelter risk. Now, you can see that in terms of the movements of crypto, insofar as that crypto has sold off heavily, whereas in contrast, gold, for example, and to some extent silver have held up pretty well. Now, on this following chart, this pie chart, this is a reproduction of something that I think I've shown before, which is a breakdown using what is in technical jargon a VAR model, which is a vector autoregression model, which basically tracks the dynamic behavior of different asset classes and how liquidity, risk appetite, and other factors really affect them. And the takeaway from this is that if you look at the decomposition of what are the systematic influences on Bitcoin, what it says that just over 40% is global liquidity. And then you've got another factor which is there in the top left-hand corner, which is saying investor risk appetite. And it's that factor, not the liquidity, which is really pulling down crypto right now. I've got to say that global liquidity is not moving up strongly. It's kind of plateauing, and we've just come through an air pocket. But, that's really the way to read it. Now, if one tries to understand what are the influences going forward on global liquidity, then let me try and explain that. And then the other thing to try and understand is what's going on with investor risk behavior, risk appetite. Now, if I come on to, I'm going to first of all do this, which is this following chart is trying to understand the risk background in markets. And what the chart is showing is the US 10-year Treasury yield in orange alongside the implied term premium on that security, on that 10-year bond, 10-year note rather. And what it's showing is that if you consider the tram lines going back probably 6 months, maybe 12 months, were very clearly indicating that there was an upward channel in yields. And, most technicians would have said, looking at that chart, we're seeing yields basically moving up back towards about 5% or maybe higher. But what you've seen in the last, let's say, 6 weeks or so, is a very clear inflection down in the yield. And that seems to be tracing at a new channel, maybe a sub-channel, but you can see it visible on the chart, which is basically indicating that we may be going to 4% yields before we go back to 5 or 5.5. And commensurate with that, what you're seeing is an inflection or a dip down in term premium. And that drop down in term premium is basically confirming what the other data just told us, is that investors are basically scrambling for safe assets. They're losing their risk appetite. And that may be, and it's quite plausibly, connected with the various maneuvers or whatever, or statements that Donald Trump is making, because we're blowing one way then the other, and there's a general air of uncertainty around. Now, what could be driving yields lower? Is there a systematic effect? And our view is, yes, there is, and it looks like the world economy is slowing down. Now, why should the world economy be slowing down? And I'll give you 2 reasons why that could be. One is that the Chinese have been pretty tight over the last 6 to 12 months in terms of their monetary conditions, largely because they're trying to arrest or hold, arrest the decline in the yuan currency and maybe stabilize it. So they've been tightening policy, and China clearly matters in terms of what it does for the real economy. And the other thing is that the so-called secret stimulus that Janet Yellen and Jay Powell imparted on the US economy last year, arguably, if you listen to what Scott Bessent, Treasury Secretary, has also suggested, that this was a deliberate attempt to try and goose the economy and get Biden re-elected, that is starting to fade away. Now, let me just address those 2 factors. On the question of the secret stimulus, what this chart here is looking at, which you can see is entitled US Fed and US Treasury, not QE, and not yield curve control. This is our attempts to calibrate that secret or sous la table injections. The orange line, which refers to what the Federal Reserve was doing, is looking at Federal Reserve activity outside of the stated QT quantitative tightening. Now, it's very interesting, at least for me, to understand that the current Federal Reserve defines quantitative tightening purely in terms of running treasuries off the balance sheet. So as those treasuries mature and roll off the balance sheet, what you see is effectively a QT policy. An earlier incarnation of the Fed, when the Fed was run by Bernanke, they defined quantitative easing at the time very differently. And they defined quantitative easing purely in terms of bank reserves. And that's the way I think is the sensible way to address it. It doesn't have any sort of political loading in that sense. It's purely looking at what money the Federal Reserve is actually injecting into money markets. And the orange bar there is the incremental injection of money by the Fed on top of whatever it's doing in terms of bond buying or bond selling or bond maturing or rolling off of bonds. So this is basically the secret stimulus, and it's largely coming in this case through changes in the Treasury General Account, but here mostly because of the rundown of the reverse repo program and the operating losses of the Fed. So that orange line, the peak in early 2024 was about $1 trillion or so, sorry, $2 trillion or there or thereabouts. And now it's run right down to virtually nothing because we know that the reverse repo program is basically spent. I mean, it's now in the realm of 100, 150, $200 billion. The other element, which is what the Treasury has been doing, which we sort of tongue-in-cheek label not yield curve control, is basically the switch that Janet Yellen made from coupon funding towards predominantly bill funding. Something like 2/3 of the deficit since the end of 2023 have been funded by bill issuance. That's Treasury securities that don't pay dividends up to 1 year maturity. It's been funded by that. Now, why is that important? It's important because at a generic level, liquidity is equal to an asset divided by its duration, very approximately. So if you're reducing the duration of your assets, here Treasury bills, so we're going from a 10-year or 7-year average maturity to a 1 year or below that, what you're getting is a significant increase in liquidity. And you can argue that logically that basically a bill takes up less balance sheet space in a financial institution than a bond or a note, and therefore the system can expand. It's more elastic. The other reason is that who buys those bills? And typically who buys the bills are banks. And banks buy bills because they are receiving at the same time significant inflows from the whopping great federal deficit, and bank deposit accounts are going up. Now banks need to match, they need both to asset liability match, but also duration match their assets and liabilities. So if they're getting increasing liabilities, which are deposits from the retail public, they'll need to match that with an equivalent asset, and what better than a 3 or 6 month or 1 year treasury bill? And that's what they do. Problem is, that is pure monetization of the deficit. So what you've got here is a situation where a year ago, this time in 2024, there was a huge stimulus thrown at the US economy that no one was really measuring. Now, bear in mind, think of these as wealth effects. It's not exactly $6 trillion of money injected into the economy because we're measuring here a concept called dollar duration. But you can think of it that there may well be, out of every dollar that's injected, you may get a 20 cents effective spending increment in terms of GDP, or there or thereabouts. I don't know what the figure is, but it's clearly meaningful. And what we're looking at now is a significant runoff of that. So what you're looking at is a slower economy coming through from that mechanism. Are you seeing the impact of that on money markets? Absolutely, for sure. So if you look at the following chart, which is called collateral surplus, what this is trying to identify is tensions in the money markets. Now, the money markets are clearly very sensitive, but then we know crypto is very sensitive. And as we are seeing here, the spread between SOFR rates and Fed funds rates are blowing out. Now, if you look at that chart over the period of the graph, what you can see is a general trend upwards. The tram lines there are showing the normal range for SOFR and Fed funds. SOFR is a repo rate, Fed funds including what the Federal Reserve tries to set. And if SOFR rates are climbing above Fed funds, it's telling you there's a shortages of liquidity really in the system. Now, what we've had over the last year is a significant number of blowouts, but something like 60 to 70% of those blowouts, if not more, have been coming since the end of July of last year. So there's a big concentration, and that's telling us that liquidity is getting tight within the US markets, and it's telling us that the Federal Reserve has to do something pretty pronto to actually get liquidity back in. They'll have to revert to QE. There's no way around this, as far as we can see, unless the Federal Reserve has got another mission. But hey, we'll see about that. In terms of the China question, I'll finish on this this slide, or this on the next one. In terms of the China question, there's a history, and there's, if you like, a carrot dangling for the future. What you can see here is the black line is the same GDP nowcast that I showed earlier on, which is showing a slowdown on the world economy. But here you've got a lot more track record. And we've put the track record in to show that this broadly aligns to liquidity injections by the People's Bank of China, which is the orange line. China, when it comes to the industrial economy worldwide, is the elephant in the room. It's ginormous. And the PBOC, the People's Bank, controls the tempo of the Chinese economy through its maneuvers. The PBOC has been through a period where it's been tightening liquidity, as you can see. That's because of attempts to control the yuan when the dollar was strong. Now what we're seeing, and by the way, this chart leads by about 6 to 8 weeks, there or thereabouts. What you can see on the pickup, or what you can see on the orange line, the PBOC line, is it's beginning to pick up. Now that would suggest that maybe the Chinese are up to something, and that is something that needs to be closely watched. Now we've been up and down before, so let's assume this may not be a trend, but there are other hopeful signs. And what I would argue is that, in terms of Chinese policy, the statement that Xi Jinping made about 2 weeks ago, when he announced or extolled the virtues of capitalism, with Jack Ma, the technology entrepreneur, sitting in the front row, is actually maybe a signal event. The Chinese like these symbolic statements. I'm reminded of a previous one, which was very important for China, which was the southern tour of Xi's predecessor, Deng Xiaoping, where he basically toured the southern provinces of China, which were the capitalist parts of the economy, and basically came out with the statement, to be rich is glorious. And that really foreshadowed a big rally in Chinese markets and in the Chinese economy as they kind of went for growth. And this may be a recurrence of that, but hey, let's see. So that's the backdrop we're looking at.
Now, let's talk really quickly for the viewer about the banks monetizing the deficit directly with bill issuance, with buying T-bills. This is a concept that I found extremely valuable over the last 2 years in trying to understand how these markets are working. So what Michael is describing is that when the government borrows and spends in a deep fiscal deficit, as it did during the pandemic response and the CARES Act, there are 3 possible ways for that debt to get absorbed. Number one, the Fed can do QE and monetize it. Banks can buy bills to offset the liabilities going up as deposits basically flow from the government into their clients' accounts. And they offset those by buying T-bills, or the money has to come from existing assets or existing deposit liabilities elsewhere in the system. That will be what we call the duration impact, where the market has to absorb larger quantities of treasury. It's also called the crowding out effect. So we have the crowding out effect, we have QE, but in the middle, we have banks buying bills to offset their liability increases as deposits flow through the system. It is so important. I found it one of the most crucial aspects of my understanding So people should review that concept. Again, Michael and I have done a few episodes on this topic. So I recommend that people go back and understand that concept itself. So now I want to ask you about coupons, the secret stimulus, um, and then, of course, the reversion to QE, which you expect from this SOFR Fed funds difference, that spread. We can talk about that. But let's talk about the rates generally coming down, liquidity coming down as a response to slowing world GDP. So, how much of that is, Michael, Trump wants a little bit of a slowdown, or they are getting what they asked for in spending cuts? Because as you spend less and you take less deficit, that's less debt being bought by banks, T-bills, to monetize the deficit, less liquidity. So what are the main drivers? Maybe you can talk a little bit more about China as well.
Yeah, let me try. I think the way that I would kind of frame this is to say that if you look at Trump 1, I think it was unambiguously about the stock market. And I think that Trump 2 is, let's say, less unambiguously, but I think it's much more about the bond market. And I think that what Scott Bessent wants is yields lower. And I think everything that they're trying to do is to try to get yields lower because they've got a serious long-term or medium-term funding issue that has to be addressed. I mean, Bessent has to refinance 30% of the US outstanding Treasury debt this year. That's a big ask. I mean, that's 3 trillion of coupon and 6 trillion of bills. The bills might be straightforward, but the coupons would be more difficult to get away. So they want lower yields, and the reason for that is that we're at the point where the debt will start to grow exponentially if interest rates remain high. I mean, it's going to grow exponentially anyway, but it's going to grow at a faster exponential rate with higher interest rates. So he really needs to get interest rates down. And that's why I think the focus is going to be much more on the bond markets. Now, as regards the economy and as regards liquidity, the cynic in me says, don't lose sight of the fact that there may be a deliberate attempt to slow the economy, or certainly attempts not to revive it right now, and to allow the economy to dip and allow the markets to dip, because we all know that everyone's got short memories here. And by the midterms, or just ahead of the midterms, they could actually revive things quite nicely. And that could be, a brilliant run through to the next elections. So you could have one bad year this year, followed by, a decent year in year 2, and then 2 great years in years 3 and 4 of the presidency. That, that would be logical. And actually, spoiler alert, that's happened quite a few times before, hasn't it? So let's not say never. As regards the need to do something, I put this chart up, which is a heat map, and this is end January. We're just updating the end February data as we speak, but it won't be radically different from this. And what it's showing is the change in hues as regards what central banks have been doing. Red is clearly stop or take liquidity out of the system. Green is adding liquidity. And what you're seeing is progressively we're in a world where more liquidity is being added. But it may be that the US is out of line here. And, this is US exceptionalism in reverse, if you like. And what I've shown here is a chart that is worth pondering on. And what it shows is 2 lines, or actually 3 lines, but let me focus on the top 2. The orange line is bank reserves. Now, I alluded to the fact earlier that Bernanke, when he was Fed chair, said the way that you measure QE/QT is purely through bank reserves. I think he's right, because bank reserves are measuring the flows of money through the money markets, and therefore that's what we need to look at. If you look at that orange line, you can see that we've extrapolated it using a dotted line in orange, and that's what we think is happening given the various pulls and pushes on the money markets over the next 12 months, or through year end, I should say. The red line that's just below that is a 1 standard deviation displacement that we have put in to try and capture the tail of reserves that are affecting the small to mid-sized banks like the SVBs, of old. They're the banks that may be vulnerable. So the big money center banks, JPM, Bank of America, etc., are probably pretty flush with cash. But if there's a reserve shortage, it's going to hit the tail much more quickly than the major banks. And what I've also put on that red line, which seemingly follows the orange, not surprisingly, is another dotted line, a red line, which is a straight line, and that is showing our estimates of adequate reserves or minimum level of reserves, if you like. If the system falls below that, you start to get problems, or if you're very close to that line, you get problems. Now you'll see that there's a step down in that line, and that step down was in August of last year when bank stress test rules were changed unilaterally by the Federal Reserve in a press notice. And that gave banks more leeway in terms of their necessary reserves. But notwithstanding that, you can see that we've been very, very close to that threshold. I mean, remarkably close, one would have to say. I mean, you look at bank reserves every week in the US, and they're pretty much a very small increment on what they were the previous week. So it looks to me that this is being stage managed pretty carefully. But our expectation is that you start to see that threshold being crossed about the middle of July of this year. And that's taking into account factors like the big increase in the TGA in April because of tax revenues, the likely spending demands that the Treasury will face, the need to rebuild the TGA later in the year after the debt ceiling is resolved, all these issues. But it looks as if there's a danger point coming sometime around the middle of the year. And therefore, the Federal Reserve will need to get ahead of the markets, not be reactive, and try to add more liquidity. They need to get bank reserves up. Now, if the Federal Reserve is not doing that, they're either deluding themselves, which is entirely possible, or they're doing this deliberately. They want to slow things down, and there's some agreement between Bessent and Powell to actually do this. There would be, clearly financial tensions going on, but you can see the closer we get to that threshold, the more tension are in money markets, as you can see from the SOFR spread.
In my opinion, there's no way that Bessent has convinced Powell to keep the money markets tight to slow down things. I totally agree with you and actually your cynical view that they want to hit the market this year to get rates down in a non-midterm election year. But I believe more that they're delusional, as you suggested. They actually think that tight SOFR to Fed fund spreads at points in the calendar are just idiosyncratic. I mean, I listened to Powell when he talks about this, Michael. He basically says, we're watching SOFR Fed funds, we're watching the money markets, but we don't think there's anything that wrong. And I really think that I take his word for it there, that they don't actually see anything so wrong, because maybe they are just delusional that this level that you've drawn here of reserve scarcity is, they always have JP Morgan to come in and lend Fed funds, or they have a discount window, or they have a standing repo facility. So I think that there is some hubris there, generally speaking, but that's a very, money market nitpick of what you're saying.
I think you're right. I mean, when I was at Salomon Brothers, my mentor, Henry Kaufman, always used to say the Federal Reserve is behind the curve. They don't understand how the markets work fully, and they're prone to make mistakes. And I think that this may be being borne out again.
We keep it on the desk here at the Bitcoin Layer. This book that
great. My favorite book.
Michael recommended to me last year. It has become one of my Bibles, Michael. It's a special book, and because it's actually, you hear, if people want to go read it, you actually hear Michael's voice, if you're familiar with his work, in these words, because this is his mentor teaching him and the world how the system actually works. It's quite different than what we are told and what the drivers are of markets. All these factors like liquidity and flow are more important, and interest rates. So I love this idea of Trump 2 is about the bond market, where Trump 1 is about the stock market. That's basically your headline here, ladies and gentlemen. Um, that's what you have to think about. So if that is correct, then how do you help boost the bond market, which is, as Michael suggested, explicitly needed to avoid exponential moves in the debt? You knock the
Well,
economy down a little bit, right? And so,
I think
yeah,
that that's certainly one thing to do. I think the other thing, which if you look at the chart I've just put up here, which is the move index. We've spoken about the move very often. I mean, it's my favorite volatility measure. And I was only talking to the inventor Harley Besant, last night about this. But if you look at the move index, why is it so important? Why is it so much more important than the VIX index? Because this really controls the effective use of collateral. So most lending today is based on collateral in some form. That collateral is largely treasury bonds. That's what people call pristine collateral. And the volatility of those bonds will govern the haircut that credit providers demand, and therefore that affects the size of the collateral multiplier. And what the Treasury needs to do is to get the move index lower, and that's one of the things that you're seeing, here unfolding. They're doing things like Treasury buybacks to try and push the move index lower. In my view, they're taking out illiquid bonds from the markets. So that's another manipulation that they're doing. But this clearly is pro liquidity in the longer term. I mean, will help leverage. So I think that's one thing. Excuse me. I think the other thing that one can start to think about is looking at tricks, if you like, if tricks is the right word, or clever manipulations, such as this whole idea of revaluing the US gold stock. I mean, that could be a significant factor to think about. And, how would that work? That would work quite simply by saying that gold is on the books at $42.22 an ounce. That was a legacy of, I think, 1972 or 73, when gold was last revalued. There's clearly a history of gold being revalued. Nixon did it, Besant did it, etc. And by the way, I mean, I think that just to throw another thought in to all this, which it maybe frames all this before I get onto the story, is that I was listening to another podcast, which was something called These Times, which is about geopolitics. And the commentators were saying in that podcast that actually, if you go back and look at the records in the early 1970s, Congress was at that stage, very pointedly making remarks against the Europeans to say, look, you guys can't have the US defense umbrella and have a trade surplus with us. Well, that kind of resonates, doesn't it? That's what we're saying today. And then it just occurred to me, well, actually, isn't Trump more like Nixon than we think? I mean, he's iconoclastic. He wants to break molds. Nixon went to China. Trump maybe wants to go to Russia, so to speak. Nixon changed the whole international monetary system by taking it off gold. Maybe Trump stroke Besant want to do something similar. So maybe that's a sort of presidency we should think about. I mean, I'm not going to conjecture about how the last one ended and how this one will, but, there are clearly parallels out there. And if you come back to the gold factor, what would happen if they revalued gold? It would be a windfall gain for the Treasury General Account and the Treasury, because depending on what level you did it at, but presumably somewhere near current gold prices, you could be getting almost $1 trillion into that Treasury General Account, which would basically mean that the Treasury wouldn't have to issue coupons for some considerable time. And that would starve the market of coupons, and it would push yields a lot lower. And that may be the sort of thing that they're thinking of. It's not unheard of. It's clearly happened before. Roosevelt did it, Nixon did it, etc. Why not? Why not? And it would help generally economies get out of debt, because what, as I've long said, is you don't need to devalue currencies against the dollar. You just need generally to devalue against the gold price, and that basically helps you reduce the real value of your debt. And that's what is badly needed right now. And if they did that, it's a huge, huge liquidity shot in the arm, of which you would expect cryptocurrencies would benefit significantly.
Since the moment the election result started to become clear, we have felt a seismic shift in the way that the world is turning. And Michael is mentioning moves that are 60 and almost 100 years old, from FDR in the 30s and the Nixon shock in the early 70s that upended the global monetary system. And this idea that a gold revaluation on the balance sheet, it was outside the Overton window. Now it's going inside it so quickly. I mean, so many people are talking about it that the common sense of it almost feels like it's going to play itself out. And this idea that we have to get debt service costs down. So anything you can do to, like Michael said, starve the market of coupons so that they can actually term out the debt. That's something that people want to know. When are they going to term out the debt? Well, if they can get rates down, then they can. So forget about terming out the debt. Focus on the bond market first and everything you can do. It's not just a slowing economy. It's other things like potentially a gold revaluation. There's so many different avenues. If they can focus on bond market strength, lower rates, then they can start to make the second and third decisions, but not until the first one is accomplished. Would you agree with that, Michael?
100%. Absolutely agree.
So Scott Bessent, who you've mentioned, I saw him on the tape, whether it was yesterday or today, he used the word roll to refer to the economy, and what I'm assuming he meant is roll over. So he said, we are starting to see the economy roll over a little bit. So the administration is already trying to get that in the psyche that there might be a growth slowdown. I don't think that we have, I think the idea of whether we're going into a administration caused recession or just a dip enough to help rates go down and end up setting up a good liquidity situation, I think that's more nuanced in opinion and something we can do on an ongoing basis. But the one thing that I do want to say is that on the move index, that is a core component to our liquidity index, Michael, TBL liquidity, because of what you've explained to us about the collateral multiplier. And we did the work, and empirically we have proven to ourselves that move is such a driver of Bitcoin prices, even that we had to back off and be like, okay, this is something we have to take very, very seriously. And on the move index and Harley Bassman, Harley is my mentor's mentor. So I
Oh,
hope to
really?
be able, yes, one
Well,
of
I spoke to Harley Bassman last night, so.
yeah, so one of his mentees, I believe they were together at CS or City back in the day, before my mentor came and worked at the firm that I was at. So I've learned a lot of things through the grapevine from Harley as well. Now, on the move index, we saw rates fall sharply over the last few weeks, Michael, but I saw a move tick up. So can you explain that concept? Because we generally think of rising prices and falling volatility together, but we saw rates spike and bond volatility fall right after the election, and we saw rates go down and bond volatility go up a little bit in the past week or so. So can you explain why that happens sometimes, but not most of the time?
Well, I think some of the recent moves in the move or bond volatility have been influenced by the election. So I think that what one certainly saw a big pickup in bond volatility through that 30-day window that embraced the election, and that's now coming off. So I think you've got other cross currents, but I think one's got to take, as we try and show there, a longer term perspective. And it's very clear that even looking through the election, the move index was elevated over the last 2 or 3 years, and it's now coming back to a normal range. As it comes back to a normal range, it has a big impact on the collateral multiplier, and that should be positive for global liquidity, or certainly not negative, which it has been over the past, as I say, 2 or 3 years. So that's clearly a tick. Ticking that box is great. If central banks continue to ease liquidity, that's another tick, okay, for sure. And we think that the Federal Reserve will be forced to do something. And certainly it seems that the Chinese need to do something. So again, that could be a positive outcome in terms of liquidity. The bogies that you've got out there, as I've outlined before, is this sort of huge debt maturity wall that starts to pick up from about the middle of this year and runs through to peak in 26, 27. And that is basically bonds that have been termed out, during the COVID emergency. So a lot of financial institutions and corporations and governments issued debt that would mature in 2026, 2027. And the beginning of that tail starts about the middle of this year. And that will clearly absorb liquidity from the markets. So that's something to bear in mind. But the gold revaluation factor will just trump that, if you excuse the pun, significantly. So we've got to be alert to that. That would be a major, major liquidity shot in the arm.
Michael Howell, CrossBorder Capital, thank you so much for walking us through these very important concepts and the concept of liquidity and why it drives financial markets. We hope to have you back soon and pick your brain even more. Please tell people where they can find your fantastic work. I'm a loyal subscriber of Michael's Substack, and his work is foundational.
Okay, well, thank you, Nick. The best way is through the Substack Capital Wars, and for institutional investors, we have institutional services, which is available at crossbordercapital.com.
We have our service also at thebitcoinlayer.com/subscribe. So go find us there. And my book, Bitcoin Age, will be with you guys in a few days. So excited to bring that out. Thank you, Michael. And we'll catch you guys next time.
Good. Thanks. I'm looking forward to the book. Thank you.
Thank you, Michael.